Yeah, maybe we can wait for another couple of minutes, 5 minutes. Baru ada 40 saja. So in the meantime, you can take your attendance for AG19 and also AG20. Okay, remember we have one quiz which is due today, and also assignment 2, which is due 2 weeks from today. Okay, we wait for another few more minutes. 42 now.
Out anything within 4 meters. So that one you have there is a modified decoy for enemies to steal. We changed it so it shoots backwards. Now here is the real one. Oh, one more thing. If you ever need to disguise yourself as a female, we now have technology that can transform you both physically and genetically. Genetically too. We managed to infuse a serum into a simple chewing gum, which is ready. Where did it go? Don't you dare. Good morning, Q. Agent number 4. What? Agent. The gadgets for your mission are ready. Great, what do we have? See.
Well, I got the results of your ultrasound, and I got some news for you.
Wait. We don't want to know if it's a boy or a girl.
Oh, okay. Well, it's not breathing. Well, I got the results of your ultrasound, and I got some news for you.
Wait. We don't want to know if it's a boy or...
You ever seen one of these things, dude? Whatever liquid this is, boils with the palm of your hand.
Oh, no shit.
Yeah.
So what happens if you...
You ever seen one of these things, dude? Whatever liquid this is,
All parents expect us to watch anime.
I ain't gonna cry too long. I'm back on my drip. Drip my drip, my drip. Right back on my drip. Yeah. I ain't gonna cry too long. I'm back.
All parents expect us to watch anime.
Alright guys, today we'll be figuring out what sound this letter makes. French, put the cheese down. But I'm going to try to feed the whole thing in my mouth. What? You know what? Whatever. English? Yeah, okay, we're gonna go with as in great. Okay. Spanish? Yes, okay, it's going to be alright, that's unique. But sometimes it's just sometimes it's the D sound. What? No, it's not the. It's the. It's not tener. It's tener. You get it? Gotcha. Yeah, I'm sure people won't struggle with that. French, how about you? As in like Paris? As in like croissant? I can't do it. Yeah, I'm doing it. Like this? We're all doing it. It's more like... Oh. I can't do either of those R's. Can we change them, please? Alright guys, today we'll be figuring out what sound this letter makes. French, put the cheese down. But I'm going to try to feed the whole thing in my mouth. What? You know what? Whatever. English?
I'm the real Ben. Shoot them. No, I'm the real Ben. Shoot them. I can't tell the difference. Tell me something only the real Ben would know. I slept with your girlfriend. What? No, I didn't. Yes, I did, and I can prove it. She's got a venom tattoo right above her lady bits. I mean, she does. What do you have to say about that? Okay, what do you think is more likely, that she cheated on you with me or with a magical shape-shifting monster? There is a good point. Do you have anything to add? No, you got me, man. It's me. Your girl's nasty, dude. I mean, she did make me wear a werewolf mask one time. Yeah, well, at least yours got to be a mask. I'm the real Ben. Shoot them. No, I'm the real Ben.
Mr. King, can I buy some land? Do you have $1 million? No, then no, you're too poor. Okay, we'll see about that. I shall grant you 2 wishes. Shouldn't it be 3? Nah, I'm the wish version. Okay, I wish I had $1 million. Okay, granted, you had $1 million. What? Okay, I wish I have $1 million. I'm taking this for taxes. What? I'm taking this for child support. I gotta go buy milk. Hey, what's that worth? This? Probably $1 million. I'll trade you the genie cup for it. Never be used. Deal. Wanna buy it for $1 million? This is a fake. I can only give you $1 for it. What? Want it or not? Fine. I'll give you $1 million for that. Deal. What? I'll give you $1 million for that. Deal. What the f? I'm auctioning my family's wagon to the highest bidder. $1,000. $1,000. Anyone else? There's also a naked painting of the royal maids. $50,000. $1 million. So, has anyone seen my wagon? Mr. King, can I buy some land? Do you have $1 million? No, then no, you're too poor. Okay, we'll see about that.
I think we broke him.
I typed out the word gullible, and then I printed it out on this piece of paper, and then I went over to the side of the building where I could climb up this I-beam and get all the way out to the middle of the roof. Then I literally put gullible on the ceiling, which was really scary because I could have fallen. I typed out the word gullible, and then I printed it out on this piece of paper, and then I went over to the side of
Did you know that it took 1 year to film this scene from The Shining? It only took 3 takes for them to get the perfect shot of the blood spilling out of
Okay,
the
good
elevator,
afternoon
which
once
normally
again.
wouldn't be noteworthy, except that each take took a whopping 9
So
days to
far
set
we
up.
have
After the first 2 tries,
60,
Kubrick said that he
59
didn't like the shot because the
participants.
blood didn't
Never mind,
look
we
like
just
blood.
continue. Right, we are now in week 12. Time is running very fast. So next week we'll be in week 13.
Genius people who
We
beat the
have
system, part 10. This
forum 5 and quiz 5 in week next week. And then week 14 will be your competency test or final exam, right? The question has been set up. There will be no more excuses. So before the final exam, any of the assessment, please ensure you clean your machine, clear cache, update antivirus software, right? So that you won't be having any problem on that day, right? As we can see, that was what happened during the midterm and also one of the quizzes. Right. So time is running very fast. We have roughly 2 weeks before the final exam. Right. I would like to take, I like, before we proceed with our lecture, I understand there's one student who would like to retake quiz number 1. Please get in touch with me as soon as possible. Okay. And also one student would like to retake midterm exam with valid reason. Okay, so again, please get in touch with me as soon as possible. Okay, so because we intend to do the replacement of both quiz and
Nice, Beth.
midterm
Excellent, Doc.
exam
You're the best.
somewhere
You really are the
next
best.
week.
You really are the best.
Right. So again, I would like to inform that the quiz replacement and the midterm exams, the questions are different from the one you had previously. I have set a new question. Okay, so this will be final. There will be no more replacement. So that is fixed, final. So get in touch with me. There are 2 students. One will be taking will retake the quiz because of machine problem, computer problem, and another one because of uploading a problem with connection, I guess, or machine. So get in touch with me as soon as possible. We intend to do the replacements somewhere next week, and that will be final. There'll be no more replacement, no more excuses. All right, I understand. Also, I received a few messages asking for me to reopen the forum, last week forum, forum ini, I think this one. Again, as we have discussed, as I've highlighted at the beginning of the semester, request for replacement will not be entertained. So there will be no replacement for forums.
Got a bit of a late start this morning?
Because you have up until 5th June, okay? So 5th June juga lah kamu minta buka, right? Hari last minute lah, baru you ask me to open. So it means last minute, it's not a valid reason, right? So some has sent me email your forum answer for the forum, so it will not be accepted, right? So you have a look. The date are all set up from the beginning of the semester actually. Yeah, so you manage your time. At last minute lah, of course. Now we have a lot of long holidays. Yeah. Yesterday, 2 days ago, holiday, a lot of holidays. Right. Any questions before we move to our lecture? That's all. So how's everyone? Okay. So I hope everyone is good, right? We had a long holiday. So I hope everyone doing good with your life and your studies as well. Right, so let us proceed with our lecture. Unless you have any questions. No questions? Very good, let us discuss our lecture. All right. Okay. So we have discussed what is financial derivatives. I hope by now everyone knows what is derivatives. Okay. We discuss about option, the difference between option and futures, pricing model, option pricing model, how to arbitrage, right, using option, and how to speculate using option, and also of course hedging, right? Then we move to futures. Okay, so futures, we have discussed the definition, how does it work, right? Convergence and other margining, right? Mark to market. So today, this is what we're going to do today. Okay, but before that, we have discussed about the pricing using the cost of carry model, whereby we want to. Pricing is very important, yeah. Pricing is very important because we want to know whether the futures price are underpriced or overpriced. Because by knowing so, we can have some indication on whether the market is moving up trend or downtrend, bullish or bearish market. So pricing, right? So we have discussed 2 weeks last 2 weeks, right? How to do the pricing, right? Okay, and also we have discussed about arbitraging using futures. Okay, arbitraging. This is a strategy. Okay, of a price, underprice, bullish market, buy futures, sell stock. Okay, we get this information from pricing, right? So by knowing whether overpriced or underpriced, we can have arbitraging strategy, buy stock, buy futures contract, and sell the underlying. If it is overpriced, we sell futures contract, we buy stock. Okay, so all this from pricing. Okay, again, you have to know what is arbitraging. So arbitraging is a trading strategy whereby a trader buy and sell in 2 different markets simultaneously in order to make profit, which resulted from market price discrepancies, right? Okay, so what are we going to do today? Today we are going to discuss about speculating using futures and also hedging using futures. Okay, so we will touch these two today. at 0. Okay, so we discussed two topics today. Speculating, and arbitraging. Sorry, hedging. Okay, so for speculating, we have to understand the most important thing is the mark to market. Okay, for this purpose, okay, we will look at one slide. Okay, so these two topics what we're going to discuss today. Speculating and hedging. Okay, but of course we can always review these topics maybe next week during the tutorial. Yeah. Okay, 1 minute, let me take the notes. Okay, there's some example here, right? So let us look together, do some revision. Okay, this one is mechanical futures market. Okay. Can you see the slide? Boleh nampak slide? Can you see it? Testing 1, 2, 3. Okay, thank you for the response.
Yes, sir.
Okay, thank you then. Okay, let us look at the slide. All right, so futures contract available on a wide of underlying. Okay, this one we have discussed, right? So what does it mean? Yeah, we have gold futures, stock futures, interest rate futures. Okay, so we have a lot of underlyings. We have palm oil futures. Those are the underlyings. Okay, so exchange traded. Okay, so it means what does it mean? Exchange traded means the contracts are standardized, so we can only buy the contract from an exchange. So what is an exchange? Exchange is Bursa Malaysia, Bursa Derivatives. So we can buy the contract from Bursa Derivatives. Okay, so in the contract, what are the specifications that need to be defined? So these are the things that must be clearly stated in the contract. So what can be delivered? Of course, the contract, of course, the underlying, where it can be delivered and when it can be delivered, right? So settled daily. Okay, this is very important, settled daily. What is the meaning of settled daily? In other words, it is mark to market. We will look at this more. We will look at this more clearly using an example later on. Okay, this is also very important. Convergence of futures and spot prices, regardless of underlyings. Okay, So this is what we call when the futures price is lower than the spot price. In this case, we call this situation contango. Contango, remember, we discussed about this a couple of weeks ago. Okay, in this case, we have spot price is higher than futures price. In this situation, the market is said to be backwardation. Backwardation, please refer your notes. Okay, whatever it is, at maturity, the price of futures and spot will converge, will be the same. Okay, regardless of what, regardless whatever the situation was, is at maturity, these two prices will meet, will have the same value, and this is what we call convergence. This is very important. Yeah, this is very important. Next. Yeah, what happened? Okay, margin. Okay, when we buy, when we want to buy this contract, or when we want to sell this contract, futures contract, we have to pay some margin. Okay, of security. Excuse me, 1 minute. Okay, remember, in Malaysia, in fact, around the world, for futures contract, for derivatives or option contract, this contract can be sold first. Okay, you sell first, then buy later. However, in underlying stock market, we cannot sell first. We have to buy first, except for certain stocks. In other words, in derivative market, there's no restriction on short selling. Have we discussed about short selling? Yes, short selling. I hope you know what is short selling, right? So we can short the stock futures. There's no restriction on short selling. However, in stock market, in the underlying market, there are some restriction. Okay, so whether you buy first or you sell first futures contract, we have to pay margin. So a margin is a cash or marketable securities deposited by an investor with his or her broker. The balance in the margin account is adjusted to reflect daily settlement, right? So this is the meaning, daily settle. Okay. So margin minimizes the possibility of a loss through a default on contract. So in other words, the margin is act as a security. Yeah. Okay, example of a futures trading. Let us look at this example. Okay, example of future trade. Okay, an investor takes a long position. What is long position? We buy first, right? In 2 December gold futures contract on June the 5th. Okay, the meaning here, okay, an investor takes a long position. So this investor is buying futures contract. What is the underlying? The underlying is gold. What is the maturity? December. How many contracts? 2 contracts. Bukan 2 December ya, tapi 2 December, 2 contract December. Right? I repeat one more time. By looking at this statement, what can we understand? The situation. The situation is that the investor is buying first position in 2. How many contracts? 2 contracts. And What is the maturity? December. What is the underlying? Gold. Okay, futures contract on June the 5th. Okay, beli pada June the 5th. Beli di mana? Di Bursa Derivatives. Alright. So the contract size is 100 ounce. So if you have one contract, it means you have the right to buy the gold at one contract means you have the right to buy 100 ounce of gold. Okay, the futures price is US dollar 1,650. So this is the price today. Today is June the 5th. So initial margin requirement is 6,000 per contract. So you have to pay how much margin? You have to pay 12,000 margin. Because 6,000 per contract and you are buying 2 contracts. Okay, so maintenance margin. What is the difference? What is maintenance margin? Maintenance margin is 4,500 contract. So again, because we are buying 2 contracts, we have to maintain 9,000. Okay, so what is the difference between initial margin and maintenance margin? So initial margin is the margin, the deposit. Okay, we have to, which act as a security to the exchange, Bursa Derivatives. Okay, so what is maintenance margin? On the other hand, is the amount, the balance in our account must not be below than 9,000. Okay, I repeat one more time. Maintenance margin is the amount of money that must always be in our account. Suppose one day the market moves against us and therefore we incur very large losses, and which resulted in the money in our account lower than 9,000. In that situation, your broker will call you to put more money, right? So let us look at one example. Any question? Okay, this is one example. All right, so I have, I think better for us to discuss in Excel. Let me get the Excel file. 1 minute. One minute there, 1 minute. Okay. Apology for the interruption. Let us continue. Okay, this is the question. Okay. Right, contract size. Right. Futures price today. This is the price today. The price at which you enter, you buy. Right. Buying price, simply put. Okay, margin, initial margin is 6,000. Maintenance margin is 4,500. Okay, so this is the price today. With the price, of course, we can get it from the screen, right? From the terminal, Bloomberg or Reuters. So these prices are given, and this is the closing price. Opening price, closing price, this is settlement price. So now you know the trade price, the difference between a trading price, okay, and settlement price. So trading price is the price we buy. In this case, we buy because a long position. Buy, selling price. Okay, buy, selling price. This is buying price. This is selling price. You buy, then you close. Contract is done, clear, right? In other words, the open interest is zero. Okay, this is the settlement price, everyday prices. All right, so daily gains, cumulative gains, balance, margin call. Okay, so this is day one. Okay, so assume at the beginning of the day, right? Maybe you enter at 10 o'clock. This is the price. So when the market closes, settlement price. This is the price at 5 o'clock, for example. Okay, first of all, we need to pay margin before we can start trading. Okay, this one is very straightforward. 2 contracts times initial margin, which is 6,000 per contract. So 2 times 6,000, very straightforward. Okay, once you pay your margin, then of course you can buy and sell. And okay, so 10 o'clock, you buy at 1650. So at the end of the day, day one, can you see this one? Boleh nampak kan? Testing 1, 2, 3. Can you see the Excel file? Testing 1, 2, 3, 2, 3, 1, testing. Is it too small? Is it too good? Thank you for the response. I know at the end of the semester, everybody is tired, right? But please, focus is very important. Thank you, Tang Yufeng, Rusni Perumal, thank you for the response. All right, any question so far? No question, very good. Thank you for the response, Adrian. Okay, daily gains. So this is the formula. This is the, so this amount minus this amount. How many contracts? 2 contracts. What is the size of the contract? 100. Okay, so we make a loss of, this is wrong though. Let me check, put some brackets. This is the loss we make for the day. But this loss is not realized. It only reduces your balance. Okay, so cumulative gains is equal to this amount. So how much money we have during the day? On the first day, our money, the balance of our margin will be this one plus this one. So now our balance has reduced to 10,000. Okay. Will the broker call you to put more money? No, because this amount, 10,000 is still higher than 9,000. So we don't have to, we can still maintain the account. Okay, the second day, similarly, we do the same thing. Let me copy the formula. This price minus this price. Okay. Okay, this is our loss for the second day. What is our cumulative gain? Cumulative gains mean our losses. Yesterday loss plus yesterday profit loss, right? So now our balance in the account is equal to minus, yeah, plus this amount. Wait, okay. This one equal to this one. Only for this day, right? Okay. So the second, third day, the market goes down again. So how much losses we making? 420. So copy. Okay. So on the second day, the broker will not call us because we still have more than 9,000, right? So the third day, we still have 9,000. Still the broker will not call us. Okay, to make it faster, right? I copy everything. Okay, on the fourth day, we make additional 1,260 losses, and our cumulative losses is jumlah semua ini ya, jumlah cumulative. And now our maintenance margin balance is lower than 9,000. So on the fourth day, your broker will call you, Mr. Tan Yu Feng, your margin is lower than 9,000. Please put more money. How much you need to put? This is the amount, 9,000 minus this amount. So you need to put more money, 1,200, sorry, 20. So you have to put amount. If not, you will make more losses, right? Or your account will be stopped. And of course, if some, right? Because this is, as we can see, this is very risky, right? The market goes down, of course, suddenly you can make profit, but at the same time, if the market moves against you, you can make large losses. Okay, because it's not easy to maintain the maintenance margin. That is why some broker, for example, in England, a trader making this kind of trading, speculating, which lead to a collapse of a bank. If you ever heard Bearing Bank, right? Hilang, right? Lenyap. Okay. So on the fifth day, sama juga. Okay, you make a profit on the fifth day. Fortunately, you make some profit. Okay, so losses will be this one. You need to plus this amount because the maintenance margin to maintain. Okay, so because we need to maintain, the account must never be below the maintenance margin, which is 9,000. Any question? So this is why it is very, very risky, right? For example, suddenly on the 5th day, the market goes down to 1,000. How much margin you need to put, right? But of course, it happens. What happens if suddenly you make a loss? This is the money you need to top up, right? A lot of money. But of course, if the price increase to 2,000, you will make a lot of profit as well, right? So nobody knows how the market goes down, goes up. One way we can have some idea is to do the pricing, right? So yeah, so this is one example of okay, this is what it means by mark to market. Your position in your account is mark to market, daily settlement. So this is the meaning of mark to market. Will be looked into, your account will be updated, right? So let us continue with our slide. 1 minute. Any questions so far? No question. Very good. Let us continue. Okay, key points about futures. They are settled daily. Okay, you need to top up. Closing out of future position involves entering into an offsetting trade. Most contracts are closed out before maturity. Okay, I forgot to mention. Let us go to the Excel file again. One very important. Okay, we actually need to, okay, this is our accounts up until the 5th day, hari kelima. So what happened if we want to close out? Okay, so in this situation, now this is selling price minus this price times 2 times 100. Okay. Okay, here, for this one, new price minus previous price, right? But in here, settlement price minus this price. It's the same, basically. New minus previous. Okay, this is wrong. This is wrong. Actually, let me get this right again. Actually, this price, previous price minus this price. Okay, 780. So your profit now, your cumulative gain losses is this amount, and your count will be this one. Okay. So what happened from your this investment? Okay, you buy at this price and you sell at this price. So what is your profit? Anyone? How much is your profit loss? Is it this amount? What is the outcome of your investment? Are you getting this one? Are you making losses or are you making profit? Or is this your profit? Buy and sell. And what happened to your deposit? Will you get it back? We sell, buy. So you're making a profit of losses of 4620, which is the difference between these two. Okay, so of course, this will be returned to you. This will be returned to you. This amount will be returned to you, 990960. So does it make sense? Okay, so how much you lost here? Okay, so this you will get your deposit, and this is your losses you make. All right, let us continue with this. So this is the meaning, yeah. There are cash settle daily. Closing out a future position involves entering into an offsetting trade. You buy, then of course you sell, right? Most contracts are closed out before maturity. Okay, so margin cash flow when futures price increases. Short trader, go to long trader. When the price increases, long trader, go to short trader. So the money movement, margin cash flow. Okay. Central collateralization in OTC. So actually this one is, we do have some over the counter. OTC is over the counter, right? But we're not going to touch this one. Okay. Again, this one we have discussed, open interest. Okay, this one is actually, we have two markets, exchange and OTC. It are the exchange, centralized, okay, and OTC. So what we have discussed here is in the trading is done via an exchange, okay, whereby all the contracts are standardized. So we can buy and sell futures contract from an exchange. So in Malaysia, we have Bursa Derivatives. Okay, where else can we buy futures contract? We can also buy futures contract from OTC market. What is OTC market? OTC is over the counter. In OTC market, the contract is tailor-made. It's not standardized. Therefore, instead of margin, we have collateral. Okay, but this one is quite uncommon. Only in Europe, in US, yeah, in Malaysia, it's quite rare. All right, but in Malaysia, basically, all buying and selling of futures contract are done through an exchange. But we do have OTC market as well. We can buy. So basically, what OTC is, it's like a buyer and seller. We discuss among themselves. So the contract they sign themselves. For example, if I and my friend, I want to buy something, I want to buy gold from him. So therefore we make a contract, me and my friend. So we don't have to go to an exchange. Tidak perlu pergi Bursa Malaysia. Okay, gold. Contoh kalau saya mau, if I want to buy gold and I want to have futures contract, instead of going to an exchange, Bursa Malaysia, I can discuss with my friend. So we agree, sign an agreement, right? So this is what we call OTC market. So of course we need to make a collateral. Okay. Okay. So this one is the clearinghouse. So we have a clearinghouse for an exchange and also for OTC. Some terminology. This one we have discussed this one actually a couple of weeks ago. Open interest, the total number of contract outstanding equal to number of long position or number of short positions, depending on which contract is unsettled, still outstanding. So again, this one we have discussed settlement price. What is settlement price? The price just before the final bell each day, used for the daily settlement process. Volume of trading, again, this one we have discussed, the number of trades in one day. Okay, this one example, crude oil trading. Okay. Okay, normally delivery seldom taking place. It's seldom to take place. Okay, so for example, if the futures contract is not closed out before maturity, it is usually settled by delivering the assets underlying the contract when there are alternatives about what is delivered, where it is delivered, and when it is delivered. The party with the short positions chooses. A few contracts, for example, those on stock indices and euro dollars are settled in cash, right? When there is cash settlement, contracts are traded until a predetermined time. All are then declared to be closed out. So delivery, for example, if I want to buy gold, of course, I will receive the gold, physical gold at the end of the day at maturity. However, if I buy composite index, for example, of course, composite index is made up of 100 stocks. It's not easy for me to buy all the 100 stocks. Instead, it is cash settled. I get the differences, right? I will not get the stock in this index, but I get cash settlement, right? So in other words, for delivery, there are two methods. You receive the physical stock, or I receive the difference in amount, right? I receive the stock. If I pay, if I long futures, for example, at the end of the day at maturity, I can receive the stock, physical stock. I hold the certificates, or I take only the difference in amount, the buying and selling price only. This is what we mean by cash settled. Futures price pattern. Okay. Futures price can be an increasing function of maturity, normal market, inverted market, and partly inverted. This is a shape, yeah? Question. When a new trade is completed, what are the possible effects on the open interest? Anyone? Okay. When a new trade is completed, what are the okay? This one. In the next question. Okay, this one. Please study this question. Maybe this question will come out in your competency test, right? Please understand this. If you have any question, you can ask me, right? So can the volume of trading a day be greater than the open interest? I don't know, maybe, yeah. Right. Types of order, limit order, stop loss, stop limit, market if touch, discretionary, time of the day, open, fill or kill. Okay, these are the instructions you give to your broker. All right. For example, stop loss. If the price reach certain level, close. Market if touch, if the price touch certain prices, buy, sell. Okay, so basically this one is arahan kepada broker. Apa yang perlu dibuat? Right. Okay, regulation of futures. This one, our futures contract is governed by, of course, governed by the Securities Commission, right? Securities Commission. So regulation is designed to protect the public interest. The regulators try to prevent questionable trading practices by either individuals on the floor of the exchange or outside group, right? So in Malaysia, this is done by Security Commission. Okay, accounting and tax. Yeah, losses will be profit losses will be tax. It is logical to recognize hedging profits losses at the same time as the losses profits on the item being hedged. It is logical to recognize profits and losses from speculation as they are incurred. What does it mean to be recognized? It has to be included. It has to be reported. Okay, profit atau loss daripada aktiviti jual beli derivatives futures perlulah direkod dalam rekod accounting tax untuk tujuan accounting dan juga tax. Roughly speaking, this is what the accounting and tax treatment of futures in the US and many other countries attempt to achieve. Yes, this is happening. It has to be recorded, has to be taken into account. In Malaysia, before you can apply for tax exemption, the activity, the hedging strategy must be shown to be effective, right? Okay. Okay, forward contract. So what is the difference between futures and forward? Basically, they are the same. Okay, but forward contract is not traded in an exchange. Forward contract can only be bought or sold from OTC market. Okay, a forward contract is an OTC agreement to buy or sell an asset at a certain time in the future for a certain price. Another difference will be there is no daily settlement for forward, but collateral may be posted. At the end of the life of the contract, one party buys the asset for the agreed price from the other party. So basically, futures and forward are the same. The pricing of futures and the pricing of forward are similar. We use the same model, which is the cost of carry model. Right? So please read again. What are the difference between futures and forward? Please, if you like, you can just Google, right? And look at some differences. For example, forward contract is a not standardized contract. Futures are very standardized contract, for example. Okay, so this is profit from long. Okay. In contrast to option, okay, remember in option we have to pay premium deposit, right? But in futures we have to pay margin, right? So this is the profit from long, forward or futures. The price increase, we make profit. The price goes down, we make losses. Okay, this is the profit loss from short position, short for futures or short forward. They are the same. The price goes down, you make profit. The price goes up, you make losses. Okay, these are some the differences between futures and forward. Please read this one. Okay, I think that's about it for speculating. Any question? No question? We take 5 minutes. 5 minutes break. Then we continue with Jing. All right. Can we continue now? Okay, remember in speculating, we also have two strategies, long speculating and also short speculating. Similarly, for arbitrage, we have two strategies, long arbitrage and short arbitrage. Okay, and likewise for hedging, we also have long hedge and short hedge. Okay, so this when are we going to use these two strategies? For long future hedge, it is appropriate when you know you will purchase an asset in the future and want to lock in the price. A short futures hedge is appropriate when you know you will sell an asset in the future and you want to lock in the price. Okay, so remember, hedging is not to make profit. The objective is not to make profit, but instead to minimize, eliminate, or reduce the risk of losses. Should we hedge or shouldn't we hedge? Okay, this is a question that has been debated for a long time, since 1970s. Should we hedge? Should we not hedge? It's similar to asking the question, should we buy insurance or shouldn't we buy insurance? Yes, we should buy insurance for security. No, we shouldn't buy insurance because we have to pay every month for nothing. But if something bad happens, it is good to buy insurance. Right? Similarly, because nobody knows what's going to happen in the future. So, argument in favor of hedging. Why we should buy, why should we hedge? Companies should focus on the main business they are in and take steps to minimize risk arising from interest rate risk, exchange rate risk, and other market variables. So what does this mean? We should buy insurance and focus on our business. We should hedge and not to worry about this risk. Okay, that's why we need to hedge, because we want to focus on our business instead of worrying about risk. By hedging, we eliminate, or we can let the contract look after these variables, market volatility, for example. But some argue that we shouldn't hedge. Argument against hedging. Shareholders are usually well diversified and they can make their own hedging. Okay, what does it mean? The shareholder can do their own hedging decision. For example, if I buy a stock from a company, I can hedge myself. I buy it from Asia, for example. I can hedge myself. I can buy and sell futures contract. So I can hedge myself. So therefore, Mr. Tony Fernandez doesn't have to hedge because the shareholder will do myself, right? Okay, next, it may increase risk to hedge when competitors do not. Right, this is correct. This is true. Because hedging is not cheap, right? We have to put margin, and again, we have to maintain the margin, initial margin, and also the maintenance margin. Next, explaining a situation where there is loss on the hedge and gain on the underlying can be difficult. What does meaning? Yes, it is very difficult to explain when we make a profit on the underlying, but losses on the futures contract. You will see later on when we do the example. We will come again to this point. What does it really mean? Because sometimes by hedging, it will eliminate the profit. But again, hedging, the objective is not to make profit. So again, this argument, this question, whether to hedge or not to hedge, has been debated for a long time. And it's like, again, I repeat, it is similar to asking the question on whether one should buy insurance or not to buy insurance. Fire insurance, should we buy car insurance? It can be yes and no, right? But for long term, for safety, of course, it's good to buy to get some protection. Right. Again, this is similar to what we have discussed. At maturity, these two prices will converge. Converge means they will meet each other. They will be the same prices. This is important, yeah, in application, both in all three strategies: arbitrage, speculate, and hedging. Okay, basis risk. Basis risk also we have discussed. I mentioned this one a couple of weeks ago. So basis, what is basis? Basis is the difference between spot and futures price. Some textbook will mention basis is the difference between futures and spot price. So actually, most textbook will use futures minus spot. Futures minus spot instead of spot minus futures, right? So basis risk arises because of the uncertainty about the basis when the hedge is closed out. So basis risk is the difference between these two. This is the basis risk, right? The difference between spot price and futures price. So we can see here the basis will be smaller at maturity, and at maturity basis will be 0. I repeat one more time. At maturity, basis will be 0. So therefore, there will be no basis risk. So actually, another way to define basis risk. So basis risk is actually the correlation between futures price and spot price. High correlations means less basis risk. Low correlation between these two prices means higher basis risk. All right. Okay. So long hedge. I think this one we do one example, then easier to understand. Yeah. Then you look at the formula. So this is long hedge, short hedge. Okay. You look at this formula. Okay. Price. Okay. All right. To understand this, I think best we do Excel later on. We finish the slide first, if we have the time. If not, we discuss next week. One example. Okay, choice of contract. Choose a delivery month that is as close as possible to, but not later than the end of the life of the hedge. Okay. When there is no futures contract on the asset being hedged, choose the contract whose futures price is mostly highly correlated. Okay, correlated with the asset price. There are two components of two bases. All right. Okay. So let me explain this one. Let us go to Bursa Malaysia derivative website. 1 minute. Okay. So this is the stock index futures. The prices for the last 6 months from 30th November last year up until 31st May last month. Okay. So every day, for example, on the 30th November, okay, we have 4 contracts to choose from. Okay, we have spot month, we have next month, we have next quarterly month, and next 2 quarterly month. Okay, so we have 4 contracts to choose from. Okay, suppose today is 30th November. Okay, I want to buy stock that make up the index. I expect to receive the money 3 months from now. So which contract should I buy? I should buy 3 months from now. So this one is spot month, means this month, November. December, next month, December. Next quarter month is March. One is March. So this is March. Next quarter month is June. Okay, so November, fourth month, because this is December, right? Okay, never mind. We use this one. We use first, this is December. Because it's the final day, right? So we use December, spot month, December. Next month is January. So next quarter month is March. Next 2 quarter is June. So today is 1st December. Okay, I want to buy stock 3 months from now. So I want to be protected for 3 months. So the question is, which contract month to choose from? Because at any point every day, we can choose 4 contracts. Okay, so if I want to have protection for 3 months, I will buy March contract. Okay, so I will buy this contract because I want to have a protection. Today is December. I want to have protection. I want to hedge up until December, 3 months. So I buy this contract. So in other words, we can choose. We choose the term of the contract based on our purpose, based on our situation. It is simply asking the question, how many years I want to buy a life insurance. Do I want to cover for 20 years, 30 years, or longer? So it depends on your situation and your capacity. Okay, so this is what it meant by choosing contract month. Okay, let us go back to the slide. Any question? No question. We go to the slide. So this is the meaning of choice of contract. Okay, choose a delivery month that is as close as possible to, but not later than the end of the life of the hedge, right? So in this case, I want to buy stock 3 months from now, but I don't have the money now. Therefore, I want to have maturity hedge at 3 months, so I buy March contract. Okay, when there is no futures contract on the asset being hedged, choose the contract whose future price is most highly correlated. All right, there are 2 components to the basis. Okay, any question? So far so good, no question? 1 minute, give me 1 minute, 1 minute, 1 minute. Okay, next question. So we know which contract to buy. We choose the contract which is as close as possible to the life of the hedge. Next question will be, how many contract to buy? We know which contract to buy. We buy March contract. Next question will be, how many contract to buy? In this case, what is the hedge ratio? So hedge ratio is the number of contract. Optimal, the best number of contract to buy. So the number of contracts is given by this formula. So this hedge is equal to the hedge ratio. Hedge ratio ataupun the number of contract is equal to the correlation divide times the standard deviation of spot divided by standard deviation of futures. So this is the formula. Find the optimal number of contracts. We shouldn't buy more contracts. Okay, we shouldn't overhedge because hedging, buying the contract, is not cheap, right? Risky. Again, we also don't want to be in the position whereby we are underhedged. Okay, so we want to have optimal hedge ratio, optimum. Okay, so how many contracts to buy or sell? So again, with this one, again, we have to do one example for everyone, for us to better understand, which of course we will do. Okay, the optimal number of contracts. There are therefore we have three formulas. Okay, so this one is the hedge ratio times the size of assets or spot divide the size of futures contract. Ataupun hedge ratio, optimal number of contract, hedge ratio times the value of assets divided by the value of futures. So we have three formulas depending on what information we have. Again, we need to have one example. If we perhaps we can discuss next Monday. Yeah, one example during Monday. What's the time now? Okay, we still have 30 minutes. All right. Okay. I think that's about it for today. This example we discuss next Monday. Is it all right? Boleh ya? Because I need to do the Excel and actually I have the Excel, but I need to update the new